The next bias, herd instinct bias, or the bandwagon effect, or the herd effect. This can happen to anyone. It really does affect, especially like the mass market, the mass market participants. And the media is manipulated so that it really stimulates the herd effect. Typical example would be in the cryptocurrency market. If you're aware of the bull run into 2017 with the ICOs, the alternative coins that was occurring. Yes, Bitcoin was going parabolic, but so were a lot of the altcoins. And so there was this frenzy. There was all media was reporting Bitcoin, altcoins, hearing of 2, 3, 4, 5, even 10,000% gains on certain coins was just quite common in those times. So everybody was jumping onto this bandwagon. And this has occurred, these euphoric stages of the market, these euphoric stages of a bull run do occur. This is a herd effect bias that is happening. And this is the psychological herding instinct is particularly apparent in the markets. That's why the media makes so much money from this. They are in the business of getting as much attention as possible. And so anything that's occurring in the markets, they will exacerbate it with headlines, with clickbait articles. You can actually look at the Google Analytics and the Google Trends of certain keywords. If you look at Tesla, for example, you'll see the popularity of this keyword search, and you can see the confluence of that, the correlation, should I say, of that with the price of the stock. The more people talk about Tesla, the more the media reports it, people will buy into it. We need to be really, really careful with this bias. And I did advise earlier to see what other traders are thinking. But I do warn that you don't want, even if you have a very experienced trader that has really good, let's say, win rate and is really good at forecasting, if your idea is opposing that trader's idea, you should still go with your own idea. You should manage your risk accordingly, right? Don't go fully in, don't go full risk on that trade, because you've taken into account other information, valid information, right, from a credible source. So we need to be able to create filters. There is so much noise in the markets. There is so much noise on a daily basis. The fundamentals, macro announcements, data, micro fundamentals, and you've got chat rooms. You've got all of this noise going everywhere. We need to be able to filter out this noise. One such example of an investor who's very good at this is Warren Buffett. Now, during the 2001, I believe, during the dot-com boom, Warren Buffett didn't get involved in that. Why? Because he understands that during these herd effect parabolic moves in the market, the mass psychology is when you see this herd effect occurring, he stayed out because he's in it for the long run. He has his strategy and he stuck to it. He didn't get suckered into this dot-com stocks. And those who did get suckered into it, into the hype, they lost out big time, massively. And so we need to be really careful with even the short moves in the market. Even like quite recently, we had so much Brexit news where one moment during the day we had pro-Brexit news, and then during the same day we had opposing news. Suddenly, like the deal was just getting further and further away. That's why you get a lot of these moves on cable that are whipsawing, and that's because certain players in the market are manipulating price, right? They're trying to sucker into a lot of retail into certain moves. You got to be careful as a retail trader with filtering out what the noise. And that's why having a clear trading plan that is based upon a strategy that you have back tested, it has a positive expectancy, and you are willing to continue to follow it even during losing streaks. That's how you're going to be able to overcome these sorts of cognitive biases.